Hello, welcome back to TNC. In this video, I'm gonna teach you 5 steps in how to develop your own retail investing strategy. This video is all about figuring out what kind of investor you are, what you want to accomplish through investing, and what kind of investing strategies might you be comfortable with. So a lot of people come and ask me for advice on what they should invest on. I can only share what I'm doing. I can only share what I think might be appropriate or comfortable for a vast majority of the people who are around my age, who are millennials. But at the same time, I'm not a financial advisor. I am not your financial advisor. In fact, you shouldn't have a financial advisor. So this video is really about teaching you how to do the necessary research and preparations for yourself to develop your own strategy instead of relying on the advice of somebody else who honestly might not have your best interest in mind. You have to educate yourself on the facts and options that are out there. So this video acts as a checklist of some sort for all the things that you need to have before the physical act of putting your first sum of money into the markets. Now, 2 prerequisites before we proceed. First, you gotta watch my previous video on why you should be starting now and why you should be starting investing in your 20s. It gives you some context as to why retail investing is really important. Also, quite importantly, please watch my other video on the 5 things that you should be doing with the first sum of money that you're receiving. It might be the stimulus payout, it might be your first paycheck, but definitely watch that video before you make any sort of investments. Just to recap, the 5 things that you really need before investing will be paying off your debt, ensuring that you have full and free access to all essential services such as food, shelter, and utilities. You have access to good health and life insurance. You have started a budgeting regime, and you have set up a rainy day fund. So don't start investing until you have all 5 elements completed and checked off the list. I'm serious. If you have, then good for you. Your life is kind of in order, or you haven't had that yet, or you haven't watched these 2 videos, stop here. I'm going to ask you to stop here, go back. Okay, I have links in the description box and up above. Please go back and watch those videos and then come back, okay? Goodbye. I'll wait for you. I'll be here. I'll wait for you. Okay, so for those who have stayed, congratulations. Everything is in order. Before we get into it, please remember to always like this video and then to subscribe to my channel if you want more future content on retail investing. Let's jump into it. Here are the 4 steps. Number 1, do your basic research about the what's, about the hows. Number 1 thing that you should be researching on is what kind of brokerage account you want to start. So a brokerage account is the account through which you do all your buying and selling transactions. Important things to note when you're doing your research are the fee structures of these different brokerage accounts and compare them across the board. Most common type of fees will be the commission fees charged per transaction. But some brokerage accounts have lots of hidden fees here and there. For example, fees will be charged for inactivity, fees will be charged for falling below a certain minimum sum, and also take note of foreign transaction costs. So some brokerage accounts have really poor foreign currency conversion rates, especially pertinent if you're buying stocks denominated in US dollars. You got to take note of that. So I will do a video in the future about the type of brokerage accounts that I'm a fan of. The second thing that you need to research on is whether or not you need to open a CDP account. The CDP account is the central deposit account. Very likely, if you're buying anything off the SGX, the Singapore Stock Exchange, you need to have a CDP account set up before you even start buying anything through a brokerage account. Again, in the future, I will make a video about this. The third thing that you need to do basic research into is the different types of asset classes. There are so many out there, but the really common ones are mainly stocks and bonds. There are also things like REITs, which are real estate investment trusts. There are also commodities such as gold, silver, and oil. A couple of these things you hear quite frequently about nowadays in the news. There are also cash assets such as Forex. There are also really complex financial products. There are often derivatives of the underlying assets, things like futures and options. So you don't need to understand very well exactly how everything works, but you need to have a general common understanding of what they are, briefly how they work. It's important to know this because it will have implications on the geography of the markets you're investing in, often out of considerations of tax and returns. So for example, because of the high tax on dividends on US stocks and bonds, should I want to invest in something that gives me a lot of dividend yield? I might seriously consider investing solely in Singapore and local stocks instead of venturing overseas. Now, on the other hand, if I'm somebody who's not very interested in pursuing dividend yield, but more interested in pursuing capital gain and growth, then dividends wouldn't be too much of an issue for me, and I will be more inclined to invest in US stocks. So the fourth thing that you need basic research into is understanding fundamental and technical analyses, when to use which and when to use both. So what is fundamental analysis? Fundamental analysis is basically macroeconomics, right? So looking at the economy as a whole, looking at the microeconomics of specific company, looking at their underlying financial strength or weaknesses. So sometimes a company with really poor fundamentals seem to be doing really well in terms of its stock price. Sometimes the overall stock market seems to be doing really well despite the fact that the macroeconomic fundamentals are really weak. So that is, for example, the US stock market right now, given how bad the global economy, especially the US economy, are right now. So it is during cases when the stock market does not correlate with the economic health in general, then we pivot slightly away from fundamental analysis into technical analysis, which is looking at trends and movements in price points. The second step is establishing your own investment horizons and expectations. So what I mean by this is asking yourself, do you need the money in the near future? What do you need it for? When do you need it? What are some of the foreseeable financial goals and plans that you have? 3 years from now, 5 years from now, 10 years from now, 20 years from now, why are you investing? Which is why it was very important for me to make the video about why you should be investing now, answering your own investment horizon question, answering your own investment goals and plans question is a very important step in parameterizing your investment strategies and options. So what do you want? Do you have a grad school to go to in 3 years? Do you have a car that you want to buy? Do you want to buy a house in 5 to 10 years? Do you foresee yourself being married? Do you foresee yourself having kids? So for me, I don't need the money right now. I know that quite clearly, right? So I don't need that in the foreseeable future, and I define that as the next 5 to 10 years. So whatever money I have left every single month after my discretionary spending goes almost entirely into my investment portfolio. I am able to take on a much more aggressive, a majority stocks, a stocks heavy investment strategy, looking at a horizon of at least 10 to 20 years. So for example, if you want to buy a house in 5 years, you will need to recoup your investments, right? Which is why then you might want to look at something that's less international, something that's more local, something that's less volatile. So more of like a Singapore-based blue chip stock that pays you dividends instead of pursuing capital gain and capital growth. Perhaps even short-term bonds or REITs that give you some moderate returns, okay? Nothing aggressive, nothing ambitious, but confers you more flexibility in terms of the buying and selling timelines. The third step then is to understand your own commitment level to investing, right? So that is really asking yourself, can you carve out sufficient time every single day to watch the markets, right? Do you have time to learn deep technical analysis day after day? Do you have time to read the charts and read the price movements? Do you have time to play around with a small amount of pilot money first, okay, to learn how to do trading? If your answer to those questions is yes, then perhaps your investment strategy should be a lot more aggressive, should be a lot more active. It should be more trading rather than passive investing. But if you don't, then you might want to consider something like passive index investing. So there's a space also somewhere in the middle where you are buying and holding in the long run, right? So your investment horizon looks like that of somebody who is doing long-term passive investing. So 10 to 20 years at the very minimum, but at the same time, you are not just relying on a single index or a couple of indices. You're doing indices, but also your stock picking like an active trader might be. The fourth step then is to understand your risk profile, which I call the greed to fear ratio, right? So how much are you willing to go ahead and be aggressive and be ambitious and get the maximum returns at an increased, more prominent risk level? To what extent do you fear that risk and are more comfortable with settling for something that is more moderate in returns? So if you want to be aggressive and you can stomach the huge waves up and down in equities market, in the stock market, and you won't be tempted to panic sell, then a strategy that focuses heavily on equities or stocks, right? That focuses on growth, that focuses on speculation of what kind of stocks and indices to buy and hold in the long run. So what I mean is you are essentially betting on, say, tech and solar energy and healthcare to really go into a boom in 10 to 20 years. In this strategy, you might want to hold more emerging markets profiles on the side, and while your core portfolio might be focusing purely on the big cap companies in the US stock market, tracking an index such as the S&P 500. Well, if you have a decent to moderate risk tolerance, you might consider then a slightly larger presence of bonds. So something like 30 to 40% of your portfolio might be bonds, with the rest probably divided between dividend stocks, right? And REITs. So stocks that pursue less of capital gain, capital growth, and more of producing a steady stream of decent secondary income, doesn't fluctuate that much, but also doesn't dip that much. So prioritizing income over growth, in this kind of strategy, you probably have pretty minimal speculation of sectors and indices and stocks and companies that might go boom in the future. In this strategy, probably you might be holding quite a bit of local holdings, local stocks and bonds, but with some international exposure, mainly in developed markets and the US. And then if you're very conservative, you're very risk averse, you want to focus on income and preserving your current capital, which I think most people watching my video probably wouldn't be pursuing this strategy, because this strategy is for somebody who's much older, who's much closer to retirement, who probably has a lot of money that they don't want to lose, that they have a lot of room to lose but very little room to gain or grow. Your strategy here might be predominantly bonds, very low yield, very safe, but also very low risk bonds, and probably a very high percentage in terms of local holdings in blue chip stocks and REITs. Okay, so that is the end of this video. This is the second video in my introduction to retail investing on this channel. From now on, the investing videos that I'm putting out will go into the concrete strategy that I have that I think a lot of people might benefit from. Again, I am not fulfilling the role of financial advisor here. I am merely spreading awareness that everybody should be thinking about these 4 steps, these 4 considerations in developing their own retail investment strategy. I really have to stress that. I am not designing a portfolio for you, but I will teach you how to design a portfolio because I've gone through those steps myself. And I've spent the time trying to figure out exactly what works for me, what doesn't work for me. So I hope this video does exactly that, help you figure out these things on your own. And once again, if you like the content that I've been putting out, please hit the like button and then subscribe to my channel for future content on not just retail investing, but also personal finance and credit cards and travel. And if you like this video, definitely share this with your friends, because I think a lot of people don't know how to start considering their own strategy. So I think this video will prove to be pretty helpful to a lot of people. Thanks for tuning in once again. Stay tuned for future content. See ya.